Today in less than 5 minutes, K&G International Advisors will give you a summary of last week's most important international financial news, focusing on why to be greedy when others are fearful. It may be difficult to remember, but at the beginning of last year, global financial markets were in a bullish mood. Equity markets and bond markets were close to all-time highs. Real estate, private equity, these asset classes too were trading on valuations at or close to their highest levels in history. Then came a series of negative surprises through the year. Continued rises in inflation to the highest levels in 4 decades, war in Ukraine and energy price spike, COVID lockdown in China. When optimistic expectations met a series of unexpected negative events, asset prices declined and volatility increased. This process reflected the mismatch between what the market thought was going to happen versus what actually happened. That was the story of last year, a bear market for stocks and bonds, as asset prices started off too high relative to what actually then transpired in the real world. When we look at the starting point for investors this year, it's a very different story. Expectations have been reset for much lower over the past year. Could 2023 end up being defined as having started with pessimistic market sentiment, which then met a reality that was better than expected? The polar opposite of 2022, lower asset valuations meeting better than expected outcomes, all else equal, result in prices of assets rising. The balance of expectations and valuations at the start of this year is much more in our favor as investors than was the case at the start of last year. Market expectations today are much less optimistic than they were this time last year. The lower your starting valuations for assets, the smaller the price declines will be from each incremental negative surprise, and vice versa, the higher the price rise will be from each new incremental positive surprise. If your starting position is one where market sentiment is overly pessimistic, this increases the probability of positive surprises. And defying a moment of overly pessimistic sentiment and market correctly can therefore be very rewarding for an investor willing to commit to buying assets and thus benefiting from subsequent price rises as those positive surprises roll in. This begs the question, are we there yet? Is market sentiment today overly pessimistic, thus creating the opportunity to buy assets and benefit from the asymmetry in positive versus negative surprises to expectations? For markets as a whole, we would argue, not yet. Dominion Capital Strategies continues to think that there could see tests of new lows of stock in the first half of 2023. But they believe that in some sectors, asset classes and individual stocks are there now. In those specific cases, valuations and sentiment are too pessimistic and offer the opportunity to take the other side as an investor. This means now is the time to be buying those assets and to continue buying through 2023. Dominion Capital Strategies thinks that some areas of the commodity sector, especially those linked to climate change mitigation, offer such opportunities. Emerging market value is another one. They have been cautiously but steadily buying into this specific sector, and stocks they see as offering this opportunity. The opportunity to, as Warren Buffett puts it, be greedy when others are fearful. The sources used on today's video were Yahoo Finance, Bloomberg, MarketWatch, and Dominion Capital Strategies. My name is Juliana Lato from K&G International Advisors, and we wish you an excellent start of the week. Also, we would like to thank you for watching our video. Don't forget to subscribe to stay updated on all the important financial news, and don't hesitate to contact us if you have any queries or further comments.